All right, welcome from Kirk Spano, margin of safety investing and fundamental trends. My investment firm is Blue Mountain Asset Management. And if you hear a dog in the background, there's two of them. The little one will be the one making the noise. In the news, Trump's tariffs. So let's start with that today. I don't know how many of you have an economics background or have studied the history of protectionism. It goes back to forever, but with this country, all the way back to George Washington. So protectionism is nothing new. However, if it succeeded, that would be something new. Protectionism and tariffs have failed pretty much every single time, sometimes worse than others. Back in the Great Depression era, partially as a response to the Great Depression, but also as a cause of lengthening it. They passed about 800 tariffs. Smoot-Hawley, I believe it was called, and dragged the Great Depression on for about 15 years. So this idea that we are somehow protecting American industry is probably wrong. It is probably inflationary what we're doing, since it's base materials that they're going after with aluminum and steel. Also, the fact that they went after solar is inflationary because it takes from the energy mix. I'm not really sure the strategic importance of the tariffs on washers of laundry washers. I'm not really sure what that one was. But if you do a little studying, what you'll realize is that there's very little to gain from these tariffs. And interestingly, the idea that everybody has in their head is that this has something to do with China. The reality is that China only exports about 6%, we only import about 6% of our steel from China and 3% of our aluminum. Our biggest trading partner in steel and aluminum is Canada, who we also went after on the solar tariffs. So unless they get exclusions, I'm not really sure what we're thinking, because historically Canada has been considered part of our security infrastructure. So I don't know what the potential win is here, other than we are trying to, or I think President Trump is just trying to make a point that he's trying to protect people, but the reality is that it probably won't. So what we will see is a little bit of inflation, probably an extra point or two, to the point where they're going to have to raise interest rates to counter that. So all of these parts are moving together, and I think we have to be very aware that if we see an extra point or two of inflation, then that means that we'll see an extra point or two in interest rates. So I think the theory here is that the president and some of his key people believe that they can drive the value of the dollar up, still inflate, and become sort of a gigantic Switzerland with a very strong dollar and protecting our industries. I think in a global economy, that's very unlikely to work, but they're the ones running things, and we'll see. I believe that we are much more likely to see a collapse in trade, and I unfortunately don't have that chart. I wanted to show it to you. I was looking at different ETFs to short and buy puts on for a drop in global trade. A shipping ETF, there really wasn't much to choose from, and there wasn't really an options market. But we already know that global trade has been trending down for a number of years, and that really has to do a lot with the demographics of the four major economies: Japan, Europe, China, and the United States, all getting older, having fewer new consumers, and the consumers in China and India just not able to keep up with the developing world. They just simply don't have enough money. So I'm not really sure if there's any logic to these tariffs other than it has something to do with politics. I see somebody has a quote here. If they could expand on that, this has more to do with NAFTA. I'm not really sure what that means. NAFTA has been probably the most successful trade agreement in the history of the world. It's pretty easy to look up. We've become more competitive under NAFTA. We have increased our exports under NAFTA. Our standard of living has gone up dramatically under NAFTA, and we have made trillions of dollars. So, the bad mouthing of the global trade agreements is really, I don't really know how to put it any other way. It's fairly stupid. So I'll probably write an article to that effect, calling the protectionists stupid outright. There just isn't much benefit to what they're doing because they're targeting our allies. They're targeting Canada. They're targeting South Korea. They're targeting Germany. I'd really like to know what the hell sense that makes. So if you have any idea that this is in any way positive, you're not going to get a lot of sympathy from me. So will they protect the domestic steel and aluminum industries? No, they're already operating at like 75% capacity. They've already downsized to the point where they're within 5 or 10 points of being where they want to be on capacity. So the tariffs may get them there, but it's really just going to drive margins and higher prices across the spectrum. So why do we want to create domestic inflation? I mean, it's one thing to devalue your currency internationally to get out of paying your debts, but to force inflation upon the American people, I would be very surprised if in 2 or 3 years we're not facing a pretty severe recession. We already know, I hope you all read the Financial Times because it's probably the best paper out there, neck and neck with the Wall Street Journal. I put the Financial Times a little bit above that. But, we're going to get, if you see your screen, we're going to get retaliation. In the state of Wisconsin, we produce a lot of cheese. So what is Europe saying? They're going to put tariffs on cheese. Why? Because they're pissed off at Paul Ryan. Again, I apologize to the American people on behalf of Wisconsin for Paul Ryan. He is not the smartest guy in the room. I've heard him speak. I've been in the room with him. That means there is at least one person smarter than him. And I just think that we are on the verge of destroying what was a very good economy with a lot of momentum that was fighting through the massive debt and the aging demographics. So if you haven't read my pieces on slow growth forever, if you believe for a second that aging demographics and global debts don't have a massive deflationary force on growth, you just don't understand economics. And I'm being a little insulting here to certain people because I want them to wake up. The aging demographics of the planet are a big deal. The massive global debts are about to become a big deal because we're not going to be able to refinance them at nearly zero interest rates. So what does that mean? When the economies of the world, when one of them finally falls out of bed, and who will it be? My money's on Japan, but it could be Europe. I know a lot of people like to say China, but that doesn't make any financial sense because they are not a debtor nation. Their federal balance sheet is a net creditor, and while they do have a bad loan structure in that country, it's not anything that their government can't pay off. So as and you just saw them, they just took over one big insurance outfit, Angbang, I think it's called, Anbang, something like that. They can write those checks. They can absorb those debts. So it's not going to be China that falls off the cliff. Japan has massive debts. They have no resources. They have an old population that's already old. China will get old over the next 20 years, but that's 20 years. Europe has massive problems as well. They could fall out of bed just because of the political nature of what they have going on over there. So we should be very ready for what happens during the next recession. And I don't think it'll be quantitative easing. They can't take on more debt for a third time to pay off old debt. The most likely thing to happen is helicopter money. So the Milton Friedman solution from 1969, the reason why Ben Bernanke had the nickname Helicopter Ben is that sometime in the 2020s, and hopefully I'm wrong, but sometime in the 2020s, we probably see trillions and trillions of dollars of helicopter money from all four major central banks, maybe from Russia and India too, and we see a major destruction of debt holdings. I would not want to own a bond. And so when people discuss with me their portfolios and they say, well, should I have 30 or 40% in bonds because I'm 60 or 65 years old? I said, yeah, well, if you want to lose a third of your money, go ahead and put it in bonds. The bonds, as Bill Gross pointed out, are probably just starting a bear market. Paul Tudor Jones, one of the greatest traders in the world, said he'd rather walk across hot coals than own bonds. And I think it's very important that everybody realize that. High yield debt is in trouble because how do they refinance it? We have slow revenue growth. We have slow earnings growth again. Everything is just at the peak and just at the very start turning over. Now, does that mean everything comes crashing down in the short term? No, probably not. Why? Why in the short term will it probably be okay? Mainly the tax cuts will help the economy, and the buybacks will prevent the crash for now. So if you can take a look at, I'm going to make this just a little bit bigger. This is a chart from Yardeni Research, the professor. And you'll see the total shares in the S&P 500 going down, 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 down for an entire decade. That's what's been keeping earnings up. It's not actual more money made. We know that there's not more revenue. Revenue's been barely up. Take a look at the S&P 500 buybacks. Screaming. They started to fall, but now we had the tax cuts, and they're going back up. And they're actually going to be over $1 trillion this year, be up around here. So that's what I'm writing about in this article that I actually been writing it for about a week. And kind of see how my process goes. I've been going through all the companies that have over $1 billion in buybacks. And I have about 20 companies to go. And you just see this list. And so you ask yourself the question, how does that manifest with these companies that are doing the buybacks? Certain companies, it's going to help quite a bit. Other companies, it's just going to prolong the inevitable destruction of their companies. I'm telling you right now, companies like Merck, I have to check to see what Pfizer is doing, and some of the other pharmaceuticals and some of the healthcare companies, they're just going to get crushed. So we have to be very careful when we want to pick out those companies, because ultimately, if you've been paying attention to what Donald Trump is doing, what President Trump is doing, is there are no sacred cows. So when he finally gets around to dealing with healthcare, think of it from a populist standpoint. What is he going to do? Well, he's going to go after the pharmaceutical companies and the hospital chains and the insurance companies. How will he do that? He will put massive downward pressure on their margins unless they figure out a way to quit expanding the healthcare pie. So all of these pieces are moving together. Healthcare, I point out, because it's such an enormous part of the economy. So bank shares have been trending down as well. But look what happened after the financial crisis. for them to get back down to the normal amount of shares is going to take forever, probably decades. So we want to be very careful about what's going on. We want to pay attention to these buybacks. Why? Because once they're gone, they're gone. There's no second hunk of money coming in. The repatriation and the one-time tax cut is it. So these buybacks will probably go into early 2019, but most of them will be made this year. So you're going to get several opportunities to sell and to strengthen this market, and I encourage you to do that. We have had some short picks. I don't know how many people shorted the S&P 500 like I told them to a week or two ago. If you did, you were up 45 or 50% on that trade as of earlier today. And we'll have to see. Do the quick shortcut here. I know that the market started to rally back. We'll see if it closes on the lows or if it rallies at the end of the day. Fridays we usually get a good end of the day rally, so we'll see. Now, if you were paying attention earlier this week on Monday, I wrote about why Europe sucks and why we should be shorting it. So take a look at that article if you haven't already. It's on both websites. I was able to get a little bit of the short Germany, the put on the iShares Germany, and I was able to get a little bit of the Italy. So, hopefully I'm right about this and Europe gets beat up. Hedgeye and Ray Dalio and a few other big traders are actually talking about this. It's a particularly good hedge because the growth in Europe already was tenuous. They just had a report come in today, down only up 1.55%. Everybody expected over 2%, or that may have been inflation. I'm sorry about that, but they got a disappointing number earlier today. I'll double check to see which one it was. And I think you're going to see these puts go up in value. They could be doublers and triplers. You can probably still get the Italy ones. If you can get those this afternoon, I'd try to sneak in there because there are elections this weekend. And I think it's going to be what everybody expects. I think it's going to be a whole lot of nobody's going to know what to think of it. So if they do get the election results that everybody's expecting, they're going to have a real hard time governing in that country. So keep that in mind. Yeah, the Fed short is up 50% last Tuesday. Yeah, right. So, I am using some pretty sophisticated tools here. This is just one of them. This is a basic quant system that I use. So you put in a symbol, and I have another one, right? So when it was up here, it was going up. It was pretty easy to tell it was probably going to come down. So we got this right here, and that was an extreme. See the yellow? It was an extreme overbought. Doom, 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 doom. It comes on right on down. So again, I don't know who does these trades, but I'm not winging it on these. We're going to be right probably half the time. And the half the time we're wrong, we'll lose half our money. But the times that we're right, we'll make way over 50% in most cases. So, these shorts, as long as you risk manage them, if they start to work against you, you close them. But if they're working in your favor, you generally ride them. It's still a sell. Germany, Europe, Italy, they all have a ways to go down. If you take a look at the 2-year chart, look how far down they can come. I mean, this is 2-year support, but there's much lower support way back 5 years ago. So If this breaks and fills this gap, comes all the way down to 35. If you bought this put for $1 or $1.50, I don't remember what it was, you're up 300-400%. So the reason Ray Dalio is shorting is because he recognizes the United States has a huge competitive advantage with Europe. Also, that I could see these tariffs coming. They've been talking about them for a few weeks. In fact, he talked about them a year ago. So if you know that this type of trade action is coming, you know that there's going to be some turbulence. And we have to be very aware of this. And I don't want people to think that this is a buy the dips economy anymore. It's not. This chart here, I've showed it before. The S&P 500 support's way down at around 2,200. So S&P 500 today is down to 2670. Right where we were the last time. If it breaks through 253, it's coming all the way down. Will it get through 253? I don't know. This is only the second test. But if it tests it a third time, probably goes through. So I think that this is an opportunity to sell some puts into this weakness because the premiums are very, very high. I will have that out right after the phone call. I was working at it as we were talking. You saw that I put out the list of 20 stocks to focus on in March, high quality stuff. You want to try to get them on the cheap. I don't know how many folks here aren't from margin of safety investing or fundamental trends, so I don't want to show the list. But feel free to take a free trial. And I think that if we are very careful, we can really, really do well in this environment. One place, and I'm going to be appearing with Dan Dicker on Monday, is oil. I keep harping on oil. And these guys, Open Square Capital, I'd follow these guys if I were you. They're not trying to sell you anything, and their reports are pretty good. So keep an eye on them. Well, they pointed out here that the inventories for crude oil are continuing to fall. Okay, so the narrative is that we're getting more and more oil, right? That's the narrative. But inventories continue to fall. And you compare this to different rolling 5-year periods, and in most of these periods, except for right here, you had inventory builds. So going into the summer season, you usually get the inventory build right before they flip over the refineries to the summer blend. So for the next couple of weeks, it's been going on for a couple of weeks now. It's got a couple of weeks to go. The refineries are flipping over their operations, doing their maintenance. There should have been a buildup in oil over the winter. Did not happen. So that means going into summer, AAA, AAA reported it today, you're probably going to see the price of gasoline jump another 20, 30, 40 cents. There simply isn't that much oil being produced. And I'll have that presentation next week for Dan Dicker, and then I'll put it on our websites same day, is that only the Permian Basin is producing more oil month over month. The Gulf of Mexico is already turning over. They had their big run last year. The Stack Scoop, which is a lot of cheap oil, has had to slow down because the state of Oklahoma is having so many earthquakes that they had to put curbs on the drilling. Nowhere else, not the Bakken, not Niobrara, not Haynesville, nothing else, not even Eagle Ford, is producing more oil month over month. They're all holding steady. So and an EIA report came out with 3 scenarios yesterday or day before. Could we produce another 2 or 3 million barrels of oil per day over the next few years? Maybe for a brief moment in time, but I doubt it. Why? Because demand from Wall Street is demanding that these companies start to have free cash flow. And that's going to be a problem for a lot of them because oil is in what is called runoff. So if you're familiar with businesses that have a depleting resource, they call the last years the runoff. And that's what we have going on in oil. You know, these companies don't have forever to pay off their debts. So it used to be that with oil companies, we believed, well, they can carry a lot of debt because there's always going to be a need for oil. 10 years out, 15 on the outside, demand for oil is going to turn over and start heading down. We already know that the laws support that. China, India, much of Europe starting to push for electric vehicles and hybrids. I mean, those are legal things. They're not going to change those laws. So we also know that there's very few major oil finds. Brazil just found a little bit, but all around the world, and I've talked about this a number of times, I don't know who gets as bored with it as I do, the projects off of Africa, in Southeast Asia, there just aren't a lot of new oil projects. The North Sea is starting to run out of oil that's easily gotten at a price. So you take a look at these current ratios for these companies. Look at all these companies. Let's flip the chart upside down. Half the companies can barely afford to be in business. Look at these quick ratios under 1. It's a ton of them. So who's going to buy their assets, right? You know, the old argument is we should just expect oil companies that need money to sell their assets. Well, sometimes they can, sometimes they can't. You know, I know Chesapeake Energy pretty well, and because the price of oil has stayed low for an extended period of time, they're running on fumes. And if the oil doesn't go up to about $80 a barrel by next summer, they're screwed. So, you know, you take a look at all these companies, they just don't have a buyer. Who's going to buy their middle of the road assets? If it's not Permian assets and it's not a handful of Gulf of Mexico, but anybody who wants Gulf of Mexico has it already. What's going to happen? Whiting Petroleum, Oasis, they're Bakken plays. You know, you take a look at these. California Resources, somebody was trying to tell me how great they were. They're junk. You know, most of these companies are junk. So what's going to happen? You're going to get the ones up here that have a lot of money, that aren't heavily in debt. These are the ones that are going to do well. So I like Devon Energy. You guys all know that I like Pioneer Natural Resources because they're becoming 100% Permian play. Conoco, they've been on the list for a while. You know, Southwestern Energy is something you have to think about if we're finally going to have a bull market in natural gas. Hess is a good company too. You know, so you go through here and you take a look and you say, okay, who are the winners? Everybody likes EOG. Well, EOG is pretty far down here. You really have to take a look at who is going to do the best. Accidental should be in here somewhere. Maybe they're. They're the biggest producer in the. Oh, here they are. They're the biggest producer in the Permian, right? So, you know, these are the companies that we want to focus on. So you'll notice who's on my list: Antero, Occidental, Encana. Look at Encana, right? That surprises a lot of people. Encana's kicking ass. And they're going to keep kicking ass. Total, I talk about. I like Total. You know, just go up this list. ConocoPhillips. Southwestern Energy might be somebody that I add if we can really put our hands on natural gas rally. But right now we're sticking with Antero because they're quite possibly going to get bought out. So there's your energy update. I've talked about how low this can go. Buybacks are going to float the market through this year. So there's some trading opportunities. Probably not a lot of likelihood of a big crash. But we still get down to 2,200, right? And if we do, it's going to pounce back up. We might not test this for months and months until autumn, maybe. Hard to know. We might get a 3, 4, 5 month rally. But ultimately, we're going to start to see numbers on trade and on GDP that probably aren't going to be very good. And then what does the Federal Reserve do? How does the Federal Reserve deal with that? Are they going to keep raising interest rates and shrinking the balance sheet into a slowing economy? Right? That's it's a pretty big deal. We could have what I've been calling a skip straight recession by next year. The first quarter next year could be negative on GDP. Remember that I said that. First quarter next year could be negative GDP. That's a big deal. All right, so let's get to a couple of questions. Does lowering gasoline inventories aid the crack spread and profits for refiners during and after the changeover, or do we stay focused? Here's the problem with the refiners, is that generally as the price of oil goes up, the spreads narrow, right? So if I'm right and the price of oil does in fact go up, and if there is a supply disruption, and I think there will be, then I don't know that I want to be with the refiners. You might as well stick with service companies, which are the most levered to higher production, right? Or catch up production, and then the companies on the very short list for energy, and if you're into ETFs, then XOP. Because that seems to be the most levered, and I really don't like Chevron and Exxon here. They have so many billions of dollars of bad assets that there's going to be a day of reckoning for Chevron and Exxon. I don't know when it's going to be, but it's coming, and I just don't want to deal with it. Plus, they don't have any growth anyway, so what's the point? Do I really want an extra 2% in dividend to have no growth? And that's a stupid approach. You gotta look at everything from a total return standpoint. And if I can make 15 to 20% on something else, why would I care about the 2% dividend on a flat stock? Can the EWI ETF be shorted for those that do not use options? Sure, you can short it, but then you have to use margin. Margin is ridiculously dangerous because you can end up owing more than you have. If you don't know that, you shouldn't even be thinking about it. And you can't do it in an IRA. So I've had a couple of people say that they can't use you can't use options. I don't know what brokers you're using that they won't let you use options. But level 1 option trading is just buying calls and puts. Level 2, depending on the brokerage, would include selling cash secured puts. So you generally have to have a net worth of 6 figures, a liquid net worth of 50 grand, and an income of 50 grand. And you have to tell them that you've been trading options for a few years to get permission. If you've been following me, I mean, you should be able to do it. But, you just got to give them the numbers and, look it up on the internet, see what they want. Fidelity, I know, is a little tighter, and Schwab is a little tighter on the option trading. TD Ameritrade loves you, baby. If you want to trade options, go to TD Ameritrade. Very easy to do. And tell Fidelity and Schwab that that's what you're going to do. Say, hey, I'm going to move everything to TD Ameritrade if you don't give me option trading capabilities. Make one of the representatives walk you through the right way to do it and get it set up. How risky are SPY Strike 292 for December? I don't know. Let's take a look. We'll do it this way. So this is, let's see if I can, I'm looking at the I use Interactive Brokers. That's basically a hedge fund platform. All right, so let's take a look at SPY. I'll see if I can share the screen. Give me just another second. Can you see my option trading screen or not? Nope. Okay, give me 10 seconds. I will change what I am sharing. Maybe I won't. There we go. New share. Here, there we go. Now you should be able to see it. So this is Interactive Brokers. You asked about December SPY puts, right? So I go way down here. I usually do the monthlies. What did you ask about? You asked about the SPY Strike 290 2018 calls. Why would you want calls? NEMAD N. Why would you want calls for SPY? Trying to sell them? You don't want to sell anything naked. All right, well, go ahead and reply when you have time. I'm not really sure why you want SPY calls for December. What is your opinion on FSL on the solar market in general? I wouldn't buy calls. No way, man. Why would you buy calls in a market that's going to be choppy? I think that's. I think you can do better things than that. First Solar and the solar market in general. I think that Trump is beating up the solar market in general. He's not going to create much of a supply chain with what he's doing. When the second biggest company out there tells you to pound sand, and they were about, Sun Power was about to build a plant here, big one, and I don't really know what they expect good to come from the solar tariffs. All that's going to do is put upward pressure on energy prices, which, gee whiz, that's good for our oil positions, but it doesn't make economic sense. The solar will come roaring back. The costs are going down so fast that the tariffs won't matter in 2 years. So that's the bottom line. This is a buying opportunity. What is the best way to protect 401k in today's choppy market? Go 50% cash. If you don't want to trade it, if you have restrictions on trading, hold extra cash. It's okay to make zero in a market that's negative, right? People get all antsy about, I want to make 2-3%. That is just a horrible approach. Horrible approach. I've seen it happen over and over again for over 20 years. Don't worry about 2 or 3%. Worry about 20 and 30%. I've been with Fidelity 20 years. They have outages. Okay. Yeah, I like Fidelity in general. They're good at my end, but I've heard that too. I don't like Schwab at all. I'll tell you what, if I was telling you to start an account from scratch, I'd tell you to go to TD Ameritrade. They have a can-do attitude. They have all the technology. They're very helpful, and they've been a pretty good steward of their capital. So I don't think you have to worry much about that. Fidelity, like I said, I do like Fidelity. Schwab is the one that I have a major problem with, is that they really just don't try to help. And, maybe I'm wrong about that in certain circumstances, but I've tried them 3 different times, and not once were they helpful to me. Anything else before we go? We actually wrap this up in 45 minutes. Limited choices in 403Bs. I have 40% in Contra Fund, 30% in Index 500. I don't know that you move it all to Contra Fund, Mike. But I think that holding 25% in a stable value account, right? Almost all these have stable value funds. I'd have 25% in a stable value fund for sure. Everybody keeps asking about these inverse and levered ETFs. Let me show you something. All right, so I need a new share. There we go. All right. All right, so go to SH. Does everybody understand how inverse and levered ETFs work? Somebody tell me no if you don't really understand it. They use futures in these. So they have to roll those positions every single day. And if they roll those positions every single day and it's and the forward pricing is higher than today's pricing, then they're losing money on every single trade. So that's why these things deteriorate. Take a look at this chart. Just keeps going down and down and down and down. Even when there was a correction, didn't do so well. Here's a better example. Right? This is another ETF that relies on futures. Anything that's futures based underneath, look. That's why you don't use these for more than day trading. Anything that is levered or inverse is designed for day trading. It is not a hedge. Not a hedge. Okay? So short, that's inverse. How would this be a hedge? Right? What direction is it going to go? There's your answer, right? It's the problem is, even though interest rates may go up, if the pricing of the futures contracts doesn't help them, if it goes against them, then it doesn't matter. Then they still don't make money. I mean, they barely made anything on that slaughter the other last week, whatever it was. I don't know if. Okay, here we go. You know what I should be using? I should be using this. Right? Looks like a mirror image. So why not just use the puts on this? Right? I'll tell you, I know that a lot of folks are scared of options or they just aren't familiar with them. But you need to be able to use options if you want to hedge. Otherwise, you sit in cash, and that's okay. It's okay to sit in cash. My dad became a millionaire just by half a dozen times in his life, getting very heavy in cash before a crash. And then after the crash, he jams it back in there. Right now he's probably only a quarter in the stock market, because he's real conservative that way. He doesn't know when the crash is coming, neither do I. I have an idea better than he does, but he knows what his risk tolerance is. And that's what you have to consider. Always consider your risk tolerance first. You can always make money, especially if you have cash when things go bad. And are things going to go bad? Eventually. Yeah, I'd have to guess it would be a couple of years from now. But, who knows? Things are moving at a pretty quick pace. These tariffs are a bad thing. We don't know what our trade partners are going to do. The fact that we are basically pissing off our allies is what has me concerned. Who's to say that doesn't play right into the Chinese hands, right? They have their new Silk Road that they want. What if everybody says, you know what? It's time to teach the Americans a lesson. And they stop trading with us. They can do without us too. What kind of growth are we going to have if it's all internal? Growth comes because the world isn't fully developed yet. We need to be a part of the Indian story and China, even though China cheats. Eventually Russia's going to grow. Africa's going to grow. The rest of Southeast Asia is going to grow. Eastern Europe's going to keep growing. Just because the four major economies aren't going to grow much, you got to pull your 2, 3, 4 points out somehow. It's not going to be done here, so, we have to keep that in mind. What's going on now is very questionable to me. I wrote this article. I'll see if we have more. Yeah. More. It has like 250 comments. So people ended up making it political in the comments. I expected that. Welcome to President Trump's Economy and Markets. You need to read this because I covered 4 things that are very important. First of all, I set some perspective. What did President Trump inherit compared to other presidents? Deregulation. It's important to understand what's going on there, how it's really being focused. I know that a lot of people just want to say deregulate for the sake of deregulating because government is bad. That's garbage. People in government are bad. Bureaucracies can get out of hand. But the reality is that there is a need for regulation because otherwise people will cheat or gouge or commit fraud. Global trade actions I covered a week before he did it. Tax cuts might not stimulate for very long. I think that's probably right. And then maybe the most important thing is Chairman Powell. And I will tell you something about Chairman Powell. He's not an economist. He really, truly, from what I've heard, doesn't understand a lot of these interrelationships. He reminds me a lot of Alan Greenspan, and Alan Greenspan presided over what ended up becoming one of the worst economic events in history. So I hope I'm wrong about Powell. I hope he's not a light version of Greenspan, but I'm afraid that he is. So it's going to be important to watch. All those things said, ultimately long-term things work out. And the volatility that I think we get over the next 3, 4, 5 years with a potential round trip on the S&P 500, there's a lot of opportunities there. Plus, the changing within the world is not going to stop, right? We're going to keep making smart everything. That's where everything's going to go. Smart this, smart that, smart the other thing. Smart everything. Quantum computers, smart cities, AI, smart cars, smart energy grid, everything. That's where there's going to be huge money. And if we can buy the really good companies as we find them on corrections, or at least before the crowd, we're going to do pretty darn well. So I am adding 3 companies to the very short list this weekend with a new link to the spreadsheet. And, I think we're going to do pretty well. And in fact, I'm actually going to take ConocoPhillips off the very short list, not because I hate them, but at some point you just run out of space for companies in the sector, and I think that you're better off with Pioneer Natural Resources than Conoco. Conoco, I think, has done everything they could. They don't really have natural buyers for any more of their assets. Selling all the Canadian assets was the surprise and probably was a great move short term. But ultimately, the Canadian assets are cheap, producing assets. So, and there's no earthquakes. So ultimately, I think Canada is a good place to be. Eventually, they'll have the infrastructure, and that's why they're getting beat up right now. Is they don't have the pipes to get all their oil to market. Few thoughts on Sierra Wireless. They are a pure play on Internet of Things, and they're starting to make money. I tried to get into them a couple of years ago. I missed. The stock doubled, and now the stock is all the way back down at round tripped. So it's probably a good buy right now. I've been selling the puts. How about foreign stocks and 401k? I'm trying to work my way up to 25% foreign holdings over the next year or two. A lot of that will have to do with the direction of the dollar. So when the dollar gets real strong, and that'll be on a crisis, whenever the next crisis comes, that's when you load up on foreign holdings. Do you do anything with currencies? Yes. One of my biggest trades was shorting the euro a few years ago, end of 2016, was it? And maybe 15, 14, I don't know. But I trade the ETFs. I use options for those because currency moves are small unless you're using futures. So I will trade the options on FXY, FXE, things like that. And I think that right now the currencies are hard to figure out. I think everybody's manipulating. You don't know which way things are going to go. Swiss franc, I think, eventually is going to break out even further because I just don't think at some point they're going to care. I think at some point they just let it run. Do you worry about Chinese debt and upcoming Chinese oil futures market? No and yes. I covered early in the call China's budget surplus or balance sheet surplus, their creditor nation, is more than enough money to take care of their bad loans within the country. And the futures market, that will evolve slowly until it happens suddenly. So think that through. It'll occur slowly until it happens suddenly. And so they will start trading futures, oil futures, apparently later this month. I think March 29th is when they said, but it's been delayed about 20 times. So who knows? That will put a dink in the petrodollar. So an article that I'm writing is the petrodollar is dying along with the petrodollar. And the reason why the petrodollar won't get beat up that badly and the dollar won't get beat up that badly is that we're exporting oil. So if we're going to export oil and gas, that reduces the need for us to have everybody else trade oil in dollars. So China is going to start buying their oil from all of OPEC in their currency, or at least partially in their currency. Maybe it'll be in line with the special drawing rights. Hard to know. But if there's a trade war, that basically forces everybody to diversify their currency because you don't know, they have to, it's risk management. They don't know which way it's going to go. So I think that the tariffs here were a bad idea for the currency. And ultimately, I will tell you this, and I've written about this. Oh, stop. Really? I hope that article isn't gone. There we go. So I wrote way back in April of 2012, back when everybody thought the dollar was going to get beat up and go to hell. And I listed a bunch of reasons why the dollar was going to be fine. Most of these reasons still exist. The dollar will be a strong currency for most of our lives, but it'll trade within a range. So you take a look at this dollar ETF. This is the one people are familiar with. Right? So in here, everybody was pessimistic. Why? Because the dollar had just gone down. People get pessimistic when things go down. And what happens? I called for a bull market, and what do we get? Long-term bull market. Three-year cyclical bull market, 4-year cyclical bull market. Now the dollar's coming down. Could it bounce back up here? It could. Take a look at this. Lower lows. Lower low, lower low, lower low. 3 of them in a row. So if this lower low gets below 23, 25, it looks like, it goes down to 23, it probably heads all the way down into the 21s. And then that probably marks the bottom for the dollar. And then 2-3 years out, again, we start having some sort of a crisis. Could be economic, could be war, could be both. Dollar shoots back up. Dollar does well in a crisis. See? Right here, dollar does well in a crisis. So right now we don't have a crisis, but seems like we want one. I don't know why we want one, but it seems like things are getting geared up to want one. It doesn't make sense to do the tariffs, not even a little bit. You can like the idea, but that's kind of like saying I like whole life insurance because it's got a savings component. Yeah, well, if you knew what the internal rate of return was on whole life insurance, with the exception of like 4 companies in the whole country, you'd be like, gee whiz, why does anybody do it? Do you think gold is going to enter a bullish cycle soon? Boy, isn't that a $64,000 question? Maybe. How's that for a definitive answer? I do think that gold will test its highs at some point in the next 3, 4, 5 years. So could you see a 50% rally in gold? Sure. But if there's a 50% rally in gold, that means the margins at the best miners do really, really well. So if you want to have a gold investment, what you want to do is either invest in GLD. You could speculate on GLDJ, which is the juniors, but you have no idea what you're in. Or you could find 3, 4, 5, 6 gold miners that have good balance sheets and good projects that are secure, that they don't have to worry about foreign governments submarining. And that would probably be the best way to speculate on a rise in gold. However, if your gold miners double, ask yourself how good that is, right? If they double, if they triple, how certain is it that that's going to happen? There are so many companies out there that are making money, changing the world. Why not just look around you and see what's changing? I talked about Itron back when they bought Silver Spring Networks from us, right? Because I was in Silver Spring Networks. I knew that they're a smart grid company. I knew a lot about them. Itron bought them. Look at Itron, right? Itron's on our list. I can never get a price on this company. ITRN, right? ITRI. Yeah, Itron. Look at this stock. So they buy Silver Spring Networks sometime last year. Go up 78, down 64. I should have bought them there. Back up to 74. This is a company that if we can get it in this range, right around here, a little under 50-ish. If we can get this stock at 50-ish, man, you back up the truck. Look at all those support points. Right there, breaks out here, levels off in here, breaks out again. For all I know, this stock could go to 400, 500. I mean, seriously. These guys are into the smart grid. They're into the water meters. I'm very familiar with that industry because Badger Meter is in Wisconsin. And I make jokes about all the dating I do. I don't really do that much dating. I just look around a lot. But I did date a woman who worked there. And so I got a pretty good understanding of how that industry works. And it's an oligopoly. There's only a few companies in there. So Itron is positioned very well in the smart grid now that they bought Silver Spring, and their water meters are up there too. So this is a company that starts getting towards 50. We're going to want to look at it, and we might even have to figure it out sooner. So I'll have to figure out if they how much money they're going to make, I guess, is the question. I don't know. I don't know how much money they're going to make. All right. Three most important tools. Well, I mean, that's easy. Where's the one that says three free reports? There you go. Here. This is how I invest. I start with a smart asset allocation derived from Benjamin Graham, who's the guy that taught Warren Buffett. So there's some street cred there. And then this approach, Core 4 investing, pretty simple. A lot to it, but it's pretty simple. Understand the secular trends. What are the largest economic trends we want to look for opportunities? Understand what the government and central banks are doing. That's why I'm so irritated about the tariffs and the central bank chairman, who doesn't seem to be very smart. Then you look at the fundamental value of the companies. Then you look at the price trend. So try to avoid catching a falling knife. If you can find a knife that's laying on the ground, right, it means somebody's eventually going to pick it up and put it back on the counter. So as long as it's done falling, you want to try to pick it up. Exact, I'm changing the buy range to 37 to 42. And Control 4 is a good company, but I think there's better. I do know that they're all the way down at the bottom of the buy range. I think that somebody needs to do a bit more of a deep dive on that. I haven't looked at them in 6, 7, 8 months, traded out of them for a 30 or 40% gain. I'm not sure if it's ready to rally again. Anything else? Try to get out of here an hour even. All right, I'm going to let you all go. And feel free to send questions on the chat or in the forum over at Fundamental Trends. All right? Take it easy.